So I hope you're all doing well and your revision is also going quite good. You're taking a full advantage of the revisions and doing your portion of, I would say, practice as well. So last time we made a kickoff in terms of Index 110. We've already finished one major chunk of consolidation, that is Index 103 on business combination, where we saw the combinations of acquisition accounting, reverse acquisitions, as well as a common control transactions. Last time I started with the inputs in terms of a control assessment, where we looked into the three broad parameters of control assessment, which is given in Index 110. In terms of keywords, one is power, second is the exposure to variable returns, and the third is the linkage in terms of power and return. Power has got further three elements looking at the existing rights and the current ability as well as the relevant activities. So as an investor, you've got some existing rights, maybe in the form of voting rights, and or you can say the right to appoint and remove the KMP, which gives you the current ability. That means when the need arises to take decisions on relevant activities. That gives you a power. But at the same time, you need to be exposed to variable returns, and the word is exposure and not entitlement. And once you establish the power and the exposure to variable returns, you develop a linkage between the two, and then the control comes in. The control assessment, you can see, is supposed to be subjective and it is not a rule-based assessment. But when we come to the practical questions in terms of doing a consolidated financial statements, yes, we do consider a slight rule-based, concept, because you're always going to see in a question that there will be a percentage which is more than 50%. So I think in a larger practical consolidation questions, control assessment would take a little backseat, because in most of the questions you will be given the voting power which is more than 50. So that is an implied control. Now we divided the understanding of Index 110 in terms of three broad blocks. One was the control assessment, which we did a quick discussions in the last class. The second, I would say, is the consolidation procedure, which is the major chunk of the standard. And then the third is the changes in the ownership interest. It could lead to either a loss of control or it could lead to a step acquisitions where you further strengthen the percentage which you've got in the investing. So now my focus today is on the consolidation procedures. And if you've attended the regular sessions, you would have seen that we follow a very systematic 7-step model. So what I'm going to do at this instance, I'm going to make a walkthrough in terms of the 7-step model with you. And of course, you know that there are certain key adjustments. And if you remember, there are broadly 5 key adjustments which are very pertinent in questions. One is the concept of intercompany owings. One is the concept of a stock reserve, which involves upstream as well as a downstream transaction. The third is in terms of fair value adjustments. The fourth is in terms of goodwill impairment. And the fifth one is the omissions by either the parent or the subsidiary, which would involve preparation of an extract balance sheet. So what I'm going to do, since we are revising, I'm just going to put all the adjustments and all these steps together. That means when you are doing a particular step, what are the crucial points you need to consider? I'll incorporate these adjustments in my mind map. So at the very start, I'm going to make a mind map and then we're going to start questions with you. And in between, when I discuss the adjustments, I will also give you what is to be done in those particular adjustments under the relevant steps. So I always tell people that, if you're able to recall the adjustments, what is to be done in a particular step, then I think the life is easy. So I think the crucial aspect is understanding the adjustment is having what impact in terms of that particular step. So let's get started and let's make a mind map on the 7-step model. So I'm going to start with, first of all, the inputs in terms of creating the mind map number 1 today. So this is on the 7-step model on consolidation. I would rather call this as consolidated balance sheet, because my focus right now is in terms of balance sheet. We'll come to the profit and loss consolidation later. So we've got a mind map in terms of 7 steps on the consolidated balance sheet. The very first step which you need to do in every question is to get the date of acquisition and get the percentage of holding. Now, I think that's not a big issue, because when you look at a larger question, I think this is something which is very apparently given in the question. So this is not going to be any challenging at all. You just need to look at the question, see the data, and get the inputs that yes, this is the acquisition date and this is the percentage. And there is no technicality, no adjustments involved in this case. Second, I would say when you go to the step number 2, it's important to see that what is the type of question. You need not tell the examiner that what is the type of question, but it is for your understanding that you should first of all identify that what is the type of question. So if you remember, if you've seen the regular sessions, you would remember I always segregate the type of questions into 2 broad categories. Either the consolidation is on the acquisition date, that means the acquisition date and the balance sheet date coincides with or without NCI, irrespective. And the second is that you're doing a consolidation at a later date. So you need to be watchful that is the consolidated balance sheet as good as the date of acquisition, or you find out that the consolidated balance sheet is at a later date. It is supposed to be at a later date. Now, when you identify that the consolidated balance sheet is on the date of acquisition, you just need to get the net assets at date of acquisition. And this is not a problem, because in this case, you can simply take the sum total of the equity share capital plus the other equity of the subsidiary company. Since you are given the acquisition date and the balance sheet date is same, you can simply take the sum total of the share capital and the other equity, because that other equity in the balance sheet is all pre-acquisition in nature. Chances of this kind of question takes a little backseat. That is just an observation. Now, when you say the consolidated balance sheet is prepared at a later date, then you need to segregate your step number 2 in terms of 2 sub-steps. The first would be that you need to do the analysis of other equity. So in this particular case, we need to do the analysis of other equity. The subsidiaries company other equity is to be split in terms of pre and post. I'll come to the inputs that what are the considerations to be applied. And then we need to get the net assets on date of acquisition. So I think once you're able to get the type of questions, you're clearly able to identify that whether we need 1 step or do we need 2 steps in terms of the consolidation process. Then we go on to the little more details on the step number 2A as well as step number 2B. So I think in this case, let's make a little more insight and let's correlate the adjustments in terms of this step. Now, I would say when you're looking at the step number 2A, there are a minimum of 3 focus points which you need to keep in mind. So I'm going to give you those 3 focus points. So this is the analysis of other equity. And as I said, you've got a total of 3 focus points in this case. So this is a minimum of the focus points which I'm giving you. Depending upon the kind of adjustments, the focus points could increase. But this is, based on the majority of the questions, you'll see 3 focus points in the balance sheet. So let's see what are the focus points in this case. At the first instance, we will be dividing the information in 3 columns. One is we'll take a column for particulars. One is you'll consider the pre-acquisition profits. And one is the post-acquisition profits. Define it in terms of dates, of course, in the question. You need to define that what is pre and what is post-acquisition. Pre-date of acquisition, anything from the date of acquisition to the balance sheet date. Now, the 3 focus points which you need to keep in mind is as follows. The first focus point. So if I consider the focus points, I would say the very first focus point is that you look at the balance sheet of the subsidiary company and you take the analysis of the other equity. So whatever are the various elements of other equity, it could be a retained earnings, it could be other components of equity. Like for example, there could be a share premium or there could be a capital reserve. So all the elements of other equity is to be segregated in terms of pre and post. So you need to just divide the information, the other equity of the subsidiary in terms of pre and post. The second focus point is looking at the stock reserve. Now, as you know that there are two kinds of stock reserve, one is upstream and one is downstream in nature. Now, we need to be careful that the stock reserve elimination, which is done in the analysis, is the upstream one. The subsidiary made a profits from the parent company and therefore it's a part of his post-acquisition earning. So this stock reserve is something which is upstream in nature, and this is going to be reduced from, you can say, the post-acquisition earnings. That is the second focus point. The third focus point is in terms of the fair value adjustments, which is most commonly seen in many questions. Because we know as per Ind AS 110, consolidation would involve a mandatory fair value changes. That means the subsidiaries, assets and liabilities will be taken at the fair value. So the difference between the book value and the fair value is going to be taken in the pre-acquisition column. So in terms of the fair value adjustments, if the fair value is greater than the book value, of course, I'm talking in terms of assets right now. So you will add this in the pre-acquisition. If the fair value is less than the book value, you'll reduce it from the pre-acquisition. Of course, liabilities goes vice versa. And then once you've considered this information, you also need to relate that this will lead to an additional depreciation, which is to be reduced from the post-acquisition. And this will lead to a reversal of an excess depreciation in the post-acquisition column. So you need to be careful that when an asset is being revalued, then the fair value changes would also change the depreciation on a prospective basis. So in this particular case, if you get a fair value gain, there is an additional depreciation. If you get a fair value loss, there is an excess depreciation. So these are the three minimum focus points which you need to keep. So when you're doing your analysis, just put yourself a question: have I taken the other equity of the subsidiary? Tick. Have I taken the fair value adjustments? Tick. Have I taken the stock reserve, which is upstream? Tick. So your mind starts working in terms of how do we handle the analysis. And then after this, we go to the step number 2B. So thereafter, we go to the step number 2B. And in terms of the step number 2B, we need to organize the net assets on the date of acquisition, and that is at fair value, which of course is being well organized in terms of step number 2A. Now, in this particular case, there is nothing complicated. It's just adding up the equity share capital of the subsidiary along with the pre-acquisition other equity, which you've already done in the step number 2A. So here, the job is pretty simple. We take the equity share capital of the subsidiary company, and to this we add the other equity, that is pre-acquisition of the subsidiary company. And this information you've already organized in terms of step number 2A. So the step number 2B is not going to pose any issues in agenda. Then comes the step number 3, which is the calculation of the purchase consideration. Now, here you should be connecting a few inputs, what you've done in terms of business combination Ind AS 103. Remember the list of 7 issues on a PC? Step number 4 in terms of Ind AS 103. Trust me, you need to be proactively considering those agendas. But most commonly, if I just put down the inputs, as far as the concept of purchase consideration is concerned, Now, let's see certain key points which you need to consider out here. One thing, which we can go wrong is, and we need to be careful on this, is investments in the parent's balance sheet could include outside investments. So I would say the first focus point, I would say the first focus point, so the first focus point which should be there in terms of PC is to identify if there is any outside investments. The first focus point is to identify that if there is any outside investments. The investments which is appearing in the balance sheet of the parent company may not just be investment in subsidiary. So you need to proactively see that if there is any outside investment. So in this particular case, when you do the step 3, look at the information that if there is any outside investment, because that would appear in the consolidated balance sheet as well. Next agenda, I would say the second focus point. The second focus point which you need to keep in mind as far as the PC is concerned, the seven issues which we covered in terms of Index 103. Because when you look at the purchase considerations, apart from the cash, apart from the shares, there could be a deferred considerations, and there could be a case of a contingent considerations. So when you calculate the PC, it is quite possible that there might be omissions. So I would say the second is that you need to keep care of those 7 issues, and I would put it as the third focus point. Because there is one particular question which came in the exams also quite recently, where there has been some omissions in terms of the PC. Let's say there is a DC, or let's say there is a CC, the contingent consideration, and if it stands omitted from the books of accounts, I would say before you proceed with the 7-step model, you should make an extract balance sheet, because the omissions would generally relate to the purchase consideration. So your third focus point is that if there is any kind of omissions, it is appropriate that you make an extract balance sheet before you begin the 7-step model. So here again, the third step has got a total of 3 focus points again. Your first focus point is to consider if there is any outside investment. Your second focus point is just recall the 7 issues when you calculate a PC, because every time the investment in the subsidiary may not be very apparently given in the balance sheet because of some omissions and all. So if there is any omissions, you need to take care of the extract balance sheet as well. That is on the step number 3. Now let's go to the step number 4. So once you've calculated the step number 3, the fourth step is the calculation of the NCI. That is the non-controlling interest. If you maintain your focus in terms of each and every step as you progress, trust me, there cannot be any troubles as such. Now, when you look at the computation of the NCI, so we need to take the NCI on the date of acquisition, and this will be purely as per Index 103. And based on Index 103, either you have taken this at fair value or you have taken this at a personal. So you need to consider first of all the NCI on the acquisition date, which is purely what you did in terms of Index 103. Now, a null connect, once you know NCI is at fair value, it is supposed to be resulting in a full goodwill. And that would mean if there is impairment, it's borne by the parent and NCI. And if the NCI is at personal, the goodwill is supposed to be partial. And in that case, if there is a goodwill impairment, it's borne by the parent company only. So to this, what we'll do, we'll add the share in post-acquisition profits. To this, we'll add the share in the post-acquisition profits. Now, when you consider the share in the post-acquisition profits, you need to look into the step number 2A and consider that whatever is the post-acquisition profits into the percentage which is held by NCI, into the percentage which is held by the NCI. Now, the only other thing which you need to be careful is that you need to make a reduction of goodwill impairment. We need to make a reduction of goodwill impairment, if any, and that also only if NCI is at a fair value, not at a personal. So I think this is you can say the computations in terms of NCI. Get this as a base, take the share in the post-acquisition earnings, and then the goodwill impairment to be reduced if there is any, but that also only if the goodwill is supposed to be full. That means your NCI was taken at the fair value. I think there's nothing more complications in terms of step number 4. Next. The next one is the step number 5, where we are going to calculate the goodwill. Or you can say it can be a capital reserve, or call it as a bargain purchase gain. So we need to calculate the goodwill or the bargain purchase gain. Now, this is nothing but, it's just a mix-up of all the information you've organized in the previous step. Because you've done the calculation of PC, the calculation of NCI, the calculation of net assets is just going to organize all the information in a chronological order. So you're going to take the purchase consideration, which you've already computed in step 3. And to this we add the NCI. And remember, this is the NCI on the date of acquisition. It is not the NCI as a total computed in step 4. That's sometimes again a mistake. You suddenly pick up the NCI, which is there in the step number 4, but that's NCI on the balance sheet date. But we need to pick up the NCI on acquisition date because goodwill is being computed on the acquisition date. So NCI on the date of acquisition is going to be picked up from the step number 4. And just to make a mention, not the entire figure. Not the entire figure. We don't need to pick up the entire figure. We just need on date of acquisition. We just need the information on the date of acquisition. So that is on the addition. Once you add this, then we're going to make a reduction in terms of net assets at fair value. It is net assets at fair value on date of acquisition, which you've computed in terms of step number 2B. So you're going to compare this with the net assets in terms of the step number 2B, and we get the goodwill. And then the most important aspect is less the impairment of goodwill, if any. Now, one thing, which people generally tend to get confused and go wrong, when it comes to reduction of goodwill, suddenly, I don't know what comes to the mind is, oh, parent has got an 80% share, so let me reduce 80%. No. This step in terms of goodwill is calculating a revised goodwill. And if it is calculating a revised goodwill, you need to make a reduction of the 100% impairment loss. You need to make a reduction of the 100% impairment loss. You don't need to consider the parent share. We need to consider the full impairment loss at this stage. NCI will take a hit of their share. The step number 6 in terms of parent will take their share. But when you consider goodwill, it doesn't make a difference whether impairment is, a partial or a full goodwill. Whatever is the impairment loss needs to be reduced. The idea is to get the revised figure of goodwill. So these are the key issues which you need to keep in mind as far as a goodwill or a bargain purchase gain is concerned. Next. The next agenda is the step number 6, which is again a crucial point, and that is calculating the other equity in the consolidated balance sheet. You can even indirectly say that this consolidated balance sheet other equity is nothing but it is a consolidated SOKI. It is nothing but a consolidated statement of changes in equity. Now, here again, let's make the life simple that when you're going to consider the other equity for consolidation, there will be three focus points again. Considering the adjustments, the focus point. Now, let's first of all consider that you're going to take the parent company, you're going to take the parent's company other equity as a base. You're going to take the other equity of the parent company as a base. And I would say again, there are going to be a total of three focus points. There are going to be again a total of three focus points. And it's easy to remember. So when you did the step number 2A, three focus points. When you did the step number 3, three focus points. When you're doing the step number 6, three focus points. And as far as step 4 and 5 is concerned, I think except for impairment, there is not much. So I think that's a little easier. But if you're able to get your step number 2A correct, if you're able to get your step number 6 correct, I think almost 70-80% of the battle is fought. So in terms of the three focus points, number 1, you need to consider the share in post-acquisition profits. You need to consider the share in the post-acquisition profits. Now, when I say that you need to consider the share in post-acquisition profits, you will get this from step number 2A, that is the post-acquisition profits. And we will multiply this with a percentage which is held by the parent company. So step number 2A will give you the post-acquisition earnings, and we're going to multiply this with a percentage which is held by the parent. The focus number 2 is the reduction of the stock reserve. And this reduction of the stock reserve is what is downstream in nature. You've already taken the upstream as a part of the step number 2A. So when it is downstream, the profits are made by the parent. So there is a need to eliminate that from the step number 6. So your mind should be clear. If it is upstream, step 2A. If it is downstream, step number 6. And the third focus point is in terms of the goodwill impairment. The third focus point is in terms of the goodwill impairment. Now, in terms of the goodwill impairment, we need to be clear. If the goodwill is supposed to be full, then I'll reduce the parent company's share. Because NCI share got reduced from the NCI, so parent share will get reduced from here. But if the goodwill is supposed to be partial in nature, then you need to reduce the 100% of the impairment figure. So what is to be reduced? That focus also needs to be very clear in mind. So these three focus points, what you need to keep in mind: the post-acquisition earnings, the stock reserve, which is downstream, and the goodwill impairment. How much to be reduced depends upon whether it is a full or it is a partial goodwill in nature. So that is the focus in terms of step number 6. Then next is the step number 7. And in terms of the step number 7, we need to make a consolidated balance sheet. Now, when you're making a consolidated balance sheet, I would say some typical issues what we need to consider. So let's, I think, put them all across. So in this case, I have given, if you've seen in the regular sessions, that there are a total of 5 rules which you need to keep in mind. And let me also add some adjustment points in a part of those 5 rules. So in this case, there are going to be a total of 5 rules which we need to take care of. So I guess if I just make my thoughts very clear regarding the 5 rules, so we can say the first one is that as far as the investment which the parent has in the subsidiary, that does not appear in the consolidated balance sheet. outside investments would appear, but as far as the investment parent has in subsidiary never appears in the console. Then the equity share capital of the subsidiary company, that also never appears in the consolidation. Then there is other equity, which is pre-acquisition in nature of the subsidiary company, that also never appears in the console. The post-acquisition does appear, but that is split between the parent and NCI that you've already taken in step number related to NCI and 6. Then we need to consider that goodwill as well as NCI will appear in consolidated balance sheet. You need to show them as separate line items in the balance sheet. The goodwill will appear on the asset side, and the NCI would always be presented in the equity section of the balance sheet. You show the equity share capital, then the other equity, and then you show the NCI. And the next one is that we need to go in for an aggregation of all the other assets and liabilities. And the aggregation of assets and liability is done 100%. Because once you achieve a control, then Index 110 gives you the fact that consolidation is always done 100%. It's called a full acquisition. Now, the key points which you need to consider at this stage when you do the aggregation is, number one, there is a need to eliminate intercompany owings. There is a need to eliminate the intercompany owings. That is one aspect when you aggregate your common debtors, creditors, etc. The second key point is the elimination of the stock reserve. So the elimination of the stock reserve, but this is only from the figure of stock. You just need to reduce the stock. The rest, the double effect is already taken in the previous steps. So it's only when you take the sum total of the stock, you need to make a reduction of the stock reserve in this case. The third is you need to incorporate the fair value changes. You need to incorporate the fair value changes and plus minus the additional or the excess depreciation as well. So these are another 3 inputs what you need to take care. Now, as far as goodwill is concerned, that would come revised post impairment. But when you're aggregating assets liability in the balance sheet, just ensure that intercompany owings is taken care, stock reserve eliminations is taken care, and the fair value changes without depreciation is done. Now, if you notice in entire 7-step summary, the mind map, I have incorporated all the 5 adjustments which I was talking of. I gave you the insights in terms of treatments of intercompany owings that goes in step 7. The stock reserve, if it is downstream in nature, in 6 and 7. If it is upstream in nature, 2A and 7. Then I gave you the third aspect of goodwill impairment. If there was a full goodwill, 4, 5, 6. And if there is a partial goodwill, then it is 5 and 6. Then I gave you the impact of the fair value adjustments in step number 2, A and 7. And then if there is any omissions, you take care of that omissions in terms of extract balance sheet. So typically all the possible kind of, normal kind of adjustments gets incorporated in the mind map. I think now I'm in a comfortable position to do some questions with you as a practice. But just ensure that when you do these steps, the focus points which I've given you should be there in your mind. And if you notice, the step number 2A, 3 focus points, the step number 3, 3 focus points, the step number 6, 3 focus points, and in terms of step number 7, 5 focus points. You just need to be very clear on the focus points in step number 2A, in terms of step 3, in terms of step 6, and in terms of step 7. If that is the case, life is simple. Now, I think let's do a question with you. I am now going to share a question to you on the screen. And this is one of the examination questions as well. So let's have a read on this case. This is a question came in June 2019 in the exams. and that came for 15 marks in the exam. So pretty easy and straight. Let's, I think, read the inputs to you. It says the summarized balance sheet of PN and SR on March 18 is given. So we're given the balance sheets of both the parent and the subsidiary. Then it says in the additional information, and as you read the information, I would also say that you should start filtering into that this adjustments will be taken in which particular step. That will keep your mind sharp. So it says PN acquired 70% equity shares of SR on 1st October 17. That's just the date of acquisition. Then it says the retained earnings of SR shows a credit balance on 1st April, that's at the beginning of the year, out of which a dividend of 12% is paid. Now, in this mind map, I did not give you any inputs on the dividends. We'll discuss that as we do this question. Then he says PN credited the dividend received to its retained earnings, because that is one point, sometimes people tend to get confused and they don't know what is to be done in terms of dividends. So I think we'll take care of this as we saw. Then it says fair value of plant and machinery on 1st October is given. The depreciation rate is 10%. Now that is fair value adjustments in terms of step number 2A as well as step number 7. Then he says the following are the increases on comparison of fair value as per respective Ind AS with a book value on 1st October, which are to be considered while consolidating the balance sheet. So this is again a fair value adjustments in step number 2A and 7. Then he says the inventory is still unsold on the balance sheet date and the trades payable are not yet settled. Then he says other reserves on March 18 are the same on 1st April 17. So other reserves on the balance sheet at the end and at the beginning of the year is same. Then he says the business of both activities are not seasonal in nature and therefore it can be assumed that profits are earned evenly throughout the year. So we are required to make a consolidated balance sheet on March 18 for the group of entities PN and SR as per Ind AS. So I don't see much adjustments except the fair value adjustments which are given in the question. That's, I think, one key focus points and the dividends. That's it. So let me, I think, start the journey on this particular question. So let's, I think, begin with the inputs in this. This is my question number in the assignment. That is 11. So let's look at the answer to the question number 11. So we're going to go with the 7-step model which I gave you. We're going to go one by one, simple inputs. Just keep a focus in mind in terms of each step. Now, before you start with the 7-step model, I would always say that you should first look into, is there any kind of omissions? And if yes, there is a need to make an extract balance sheet. Fortunately, I am not given any such information, so which means no extract balance sheet. So we begin with the inputs in terms of step number 1, getting the date of acquisition and getting the percentage. So if I look at the date of acquisition, it's very clearly given. PN acquired shares on 1st October 17. And the percentage is given to me, it is 70%. That's a direct information. Now, we know the type of question already in this case. What is the type of the question? We are making a balance sheet at a later date. Acquisition is 1st October and the balance sheet is March 18. So it is at a later date. So you need to divide your step number 2 in terms of 2 parts, 2A to B. So let's proceed with the step number 2A. And as you go to step number 2A, keep your focus points in the mind. So we need the analysis of other equity. So first, I think we'll draw a chart organizing the pre and the post acquisition columns to get the data very clear and then proceed. So we define the pre-acquisition profits and we define the post-acquisition profits and we take this as particulars. So let's define first of all what is pre-acquisition. Anything before the acquisition date, so make a mention, this is pre 1st October 17, and anything from the acquisition date till the balance sheet date, that is March 18, is post. And I think your observation should immediately go to the post-acquisition column as well, that in this case, we can say only 6 months out of the current year is post. Because later, if you need to consider anything in a time ratio, you need to be very focused clear. Because the common mistakes which are made is when this is, let's say, around March 20, and then we forget to see that this is covering a period of, not 6 months or 1 year, but it's almost like 2.5 years time. So we need to be very clear that what is the period of the post acquisition, because time ratio depends on that. Now, considering the three focus points, as I said, let's come back. So in terms of the first one, we'll go back to the balance sheet of the subsidiary. Now, if you see the balance sheet of the subsidiary, there is other reserves and there is retained earnings. So you need to pick them one by one. Focus point one. So let's consider first of all the other reserves. So when I look at the other reserves, I think it's a good input that you make a smaller time scale in the inner column. See the status at the beginning of the year, 1st April, and this is 31st March. So it would be a good idea that you make a time scale and see the date of acquisition is 1st October. Now, let's note down the information. It says in point number 7, other reserves on March 18 and is same on 1st April 17. So your other reserves are appearing at 3,12,000, and it says that it was 3,12,000 even at the beginning of the year. So there has been no movement during the year. So this entire balance becomes pre-acquisition in nature. So we put it in the pre-acquisition column. As simple and as straight. Let's extend the analysis. So I'm not putting the headings again. We know this is pre-post. So I'm just going to write down pre-post and proceed. So this is pre and this is post. The second is we look at the retained earnings. Again, we just draw a small time scale to get the information on 1st April and 31st March, and the date of acquisition is 1st October. Now, in terms of the retained earnings, the balance on the balance sheet date is 255,800. This is 255,800. And if you look at the retained earnings, it's given in the point number 2. Retained earnings on 1st April 17 is 93,600. Now here becomes a little crucial point. So you are given the retained earnings at the beginning and you're given the retained earnings at the end. But before we take the difference, it also very clearly says in the point number 2 that out of which a dividend of 12% was paid. Now, when you pay a 12% dividend, naturally this 93,600 is not there at the end of the year. So we will reduce the amount of dividends. So on the share capital that is given to me 6,24,000, we take a 12% dividend, that is 74,880. So we can get the balance, that is 18,720. Now this is comparable because this is also after reducing the dividend and this is also after reducing the dividend. So 18,720, that becomes pre, and you can take the difference between the two, that is 237,080. But this increase is during 12 months and it is supposed to be divided in the time ratio. 6 months is pre and 6 months is post. So we divide this, that comes to 118,540. So 118,540. This is the current year profit divided in the time ratio. Okay, wonderful indeed. Now, there is something which needs to be taken care of, which I will tell you later, but this reduction of dividend is now going to trigger some problems, which we'll take care of. And I'll tell you what is to be seen. So this is one focus point done. Now let's go to the next focus point. And the next focus point is the fair value adjustments. Once you've taken care of this, we come to the fair value adjustments. And for this, we are given in the point number 5. It says the following. First, I think the point number 4 and the point number 5. In terms of point number 4, it says the fair value of the plant on 1st October 17 is 624 and the depreciation rate is supposed to be 10%. Now, very carefully what you should do when you take the plant and machinery, just again take a timeline to be on a safe calculation, 1st April, 31st March, and this is 1st October. Now let's note down the data. If you look at the balance sheet of the subsidiary, the plant and machinery is appearing at 421,200. And the first thing is, if you want to get the fair value increase or loss, you need the book value on the date of acquisition. So there is a backward calculations required. Your depreciation is at the rate of 10%. If it is at the rate of 10%, that means this figure represents 90%. So 421,200 divided by 90%, this works out at 468. This is first of all a backward calculation, grossing it up, dividing it by 0.9. Now we need to get the figures on the date of acquisition. So from this 468, you take a 5% reduction, it is 444,600. Then you compare this with the fair valuation. So the fair valuation is given to me, it is 6,24,000. So I think it is always good to organize the information on a timeline. You will clearly see that what is the book value on the date of acquisition and then compare it with the fair value. So this comes to, I think, 179,400. That would be pre-acquisition in nature. And immediately when you consider the fair value adjustments, then there is a need to consider the additional depreciation as well. Now, once you consider the additional depreciations, we are going to consider that we have taken the depreciation on this figure, but we should have taken a depreciation on this figure. So we'll consider from the post-acquisition column the additional depreciation. So I think let's calculate the additional depreciation. 624 is what I should have taken a depreciation. 468 is the figure on which we have taken the depreciation. So on this 156, there is a need to consider a 10% depreciation for a period of 6 months. So we take a 6 months depreciation that works out at 7,800, which is post-acquisition date. So that is one fair value adjustments for the plant and machinery. See, once you keep your focus clear, it's not a difficult job. Then let's proceed further. Let me get the extended analysis further. So the pre and the post acquisition. So this is pre and this is post. Now there are some more fair value adjustments which are given in the question apart from the point number 4. There is something in the point number 5, land building, inventories, and trade payable. And the best part is inventories are still unsold and trade payables are still unsettled. So we can comfortably consider this. So there is a fair value adjustments further, which is given for the land and building. It is given for the inventory and it is given for the trades payable. So as far as land and building is concerned, it is 3,12,000. I would have also considered the additional depreciation, but I think in the absence of any depreciation rates, we cannot consider that. Inventories is 46,800 and trades payable is going to be an increase. That's a loss. Increase in the asset is a gain, but increase in the liability is going to become a loss for us. I think that's it. So I think my second focus point is done. The balance sheet, other equity analysis done, the fair value adjustments done, and I don't see that there is any stock reserve calculations. So we are in a comfortable position. to get the sum total of this. So let's see what is the pre and the post. So pre is 3,12,000 plus 18,720, 118540, 3,12,000, 46,800. I think this is coming to 956,260. That's 956,260. Okay, and then let's consider the post acquisition as well. So post acquisition is 118540. This is, I guess, coming to 110740. Okay, now comes the crucial point. Once the analysis stands done, I think now it's very important that because of this dividend, we need to be very careful. So I've always advised, if you've seen the regular sessions as well, that once you're given a dividends, it's a good practice that in step number 2B, you calculate two net assets. One is the net assets without reducing dividends, and one is the net assets after reducing dividends, because these two different calculations will be required in different steps altogether. So it's a good idea that when you do the step number 2B, in terms of the step number 2B, when you would organize the net assets at fair value on date of acquisition, it's a good idea that you organize two net assets. So one is you organize the net assets which is after reduction of dividend, and one is before reduction of dividends. So the one is before deduction, one is considering before the dividends, and the other one is considering after the dividends. That would be a good exercise to do, because depending upon the subsequent steps will filter which information is required, and accordingly you can decide which information do we need. But let's first organize. Now, in this particular analysis, what we did when we were doing the calculations of the retained earnings, we already made a reduction of this dividend. So once you made a reduction of the dividend, this other equity is already after reducing the dividends. So this other equity available to me is after dividends. So we add the equity share capital and the other equity which is pre-acquisition. So let me just pick up the data. So this is 956,260. And you look at the equity share capital of the subsidiary, it is 624. So equity share capital plus the other equity which you got from the analysis. Now this figure is after dividends. Let's do one thing, just add back the dividends out here to get this information. So we had taken the dividends which was 74,880. Just add this back. It is supposed to be 10,31130. So that comes to 10,31130. So okay, let me just, I think, quickly check the figure. This dividend was 624, 12%, 956,260. Yes, 10,31,130. Okay, so now with this particular informations in hand, we are in a comfortable position to just add this up. This is 1655,130. And this is 158260. Okay, let me just, I think, cross verify the sum total of these figures. This is 3,12,000. And this is going to be 118,540, 18,720, 179,400. This is 3,12,000, 46,800. Yes, this is 956,250. And this is 74,880. So I think there's a little calculation error. This is slightly 10 rupees more. This is 10,31140. This is 1655,140. Right. So I think once we get this information, and I again say that it's a good idea that when you are given a dividends in the question, I think in step number 2B, please organize one is before and after dividend. The life will become very simple as we proceed to the further steps. Okay. Now, once this is done, we go to the step number 3. The step number 3 is the calculation of the purchase consideration. And I've got my focus points again. And in this particular case, I don't see any omissions. I think as far as 7 issues is concerned, not to worry, because the balance sheet is very clearly showing the investment. So there's no omissions, no 7 issues involved. So there is no outside investment as well. It's given in the balance sheet clearly 12,48,000. This is the investment which is appearing in the balance sheet of the parent. Okay, then let's go to the step number 4. So in terms of step number 4, we need to calculate the NCI. And as far as NCI is concerned, I don't think so. We are given any information in the question that it is a fair value. So by default, NCI is always taken at a plus mark. Now it's time to be a little careful that when you take the NCI on date of acquisition at Pasna, since we need the NCI on the date of acquisition, your focus point is clear. We need the net assets before dividends. We need the net assets before dividends. That's what comes in the mind. That's what comes in the mind. That NCI on date of acquisition is the figure before dividend. But I am calculating the NCI on the balance sheet date. Since you're calculating the NCI on the balance sheet date, the dividends have already been paid. So what do you need to do? You need to consider this after dividend. That's one focus point. That as far as dividends are concerned, when you take the NCI, when you write that it is the NCI on acquisition date, your mind will tell you that I need to take the net assets without dividends. But we are calculating the NCI on the balance sheet date, so take it after. So let's get the information. So we've got the figure after dividend, 1582.60. 1582.60 into 30%, because 70% belongs to the parent. So let's take 30% of this. So that works out at 1582.60 into 30%. That is to the tune of, we get 474. That is 474,078. Right, so this is the NCI on the date of acquisition which we get, and then we consider plus the share in post-acquisition profits. We get the share in the post-acquisition profits available from step number 2A, and the post-acquisition is 110740. So this is 110740. And we need to take 30% of this. So 110740, 30% would mean 33,222. We get the sum total of this. And I think there was no goodwill impairments, which was defined. So let's add this. This comes to 507,300. So this is the focus points which we need to keep in mind as you're calculating the NCI, that you need the net assets, which is after reducing the dividends, because this NCI is on the balance sheet date. So we took the net assets post the dividends and added the share in the post-acquisition earnings. Now let's go to the next step, that is step number 5, which is the calculation of the goodwill. or the bargain purchase gain, call it as a capital reserve. So now it's all organizing the information, getting the purchase consideration, adding the NCI on the date of acquisition, and then reducing the net assets on date of acquisition. Now here again some crucial inputs to be considered. Here again, because of this dividends, there are certain crucial points to be taken, and I think, get them very clear. Goodwill calculated on the date of acquisition does not change unless there is an impairment. When you were calculating the NCI was for the balance sheet point of view, as on the balance sheet point of view. Goodwill, which is computed as per Ind AS 103 on the date of acquisition, appears in the balance sheet as well, unless there is impairment, and there is no impairment. So in this particular case, the focus is clear. When you consider the NCI on the date of acquisition, we need it before dividends. We need this before dividends. So do not take this information from the step number 4. Do not take the NCI from the step number 4, because in step number 4, you took the NCI after the dividends. So don't take the mistake of picking up that NCI from the previous step. Take the figure which is before the dividends. And then once again, you need on the date of acquisition. So this is also which is required before the dividends. This is also required before the dividends. So the key aspects which you'll have to keep in mind is when there is a dividend, you calculate 3 focus points again. When there is a dividend, there are 3 focus points again. You calculate 2 net assets. One is before and one is after reducing dividends. When you take the NCI, you take the figure after dividends. When you take the goodwills, you take the net assets before dividends. Okay, now let's get the information. So purchase consideration is already given, 12,48,000. So this is 12,48,000. And let's take the net assets before dividends, 16,55,140. 16,55,140. And you can directly take 30% of this as an NCI. So 16,55,140 into 30%, that's 496,542. Well, the step number 5 is done. Now let's proceed with the step number 6. So we go to the step number 6, and that is calculating the other equity in the consolidated balance sheet. Now here again, you've got a total of 3 focus points again. Considering the parent company's profit as a base, 1. And second, we need to consider the figure which is number 1, goodwill impairment, number 2, the post-acquisition profits, and the stock reserve if it is downstream in nature. There is no stock reserve downstream, there is no goodwill impairment, so all we just need to consider is the post-acquisition share. But there is one more inputs which we'll consider. So let's take the parent companies. The parent company's RE as a base. So when you consider the parent company's RE, so there is other reserves and there is RE. So we need to take a separate columns for both of them. So let's take the parent company's figure as a base. The other reserves is appearing at 9,36,000. And the retained earnings is given to me, it's 178,400. So first we consider the share in post-acquisition. So first we consider the share in the post-acquisition profits, and that's available in the analysis. So 110,740. So this is 110,740 into 70% belongs to the parent. So 110,740 into 70%, that's 77,518. Now, I would say here the focus in terms of three-step switches to four focus points now. You take care of the share and post-acquisition profits, one. You take care of the goodwill impairment, two. You take care of the stock reserve downstream, and now the fourth one, which is the additional point. This profits of the parent company is after crediting the dividends received from the subsidiary. So what he did was correct. The subsidiary paid a dividend, he credited that to his retained earnings. But there is no income from the group point of view. Since there is no income from the group point of view, there is a reduction required in terms of dividend received from subsidiary. So we need to make a reduction of the dividends received from the subsidiary. So 6,24,000, dividend was 12%, 70% belongs to the parent, that is 52416. I think now that takes care of the entire inputs. So let's get what is the other equity in the consolidated balance sheet in this case now. Okay, so let's consider what is the post-acquisition figure other equity. So let's take the sum total. This remains at 936. And this is 178,400, 77,518. And this is minus 52,416. This is 203,502. Okay, superb. So I think with this information is now in hand, we are ready now to go to the consolidated balance sheet as well. Okay, so that was interesting. Now you can see the focus points very clear, which adjustments to be done where. And I think as far as dividend is concerned, the three focus points again. Now let's go to the step number 7, which is making the consolidated balance sheet. So it could be a little time-consuming process, but if you just go step by step, trust me, it's going to be easy because then your focus is very clear that what is to be done at each stage. Now, when you make the consolidated balance sheet, I would advise that we should follow a simple concept. Particulars, take one column for the parent, one for the subsidiary, and one for the adjustments, and one for the consolidation. So you take a column for the parent, subsidiary, do the adjustments, and then get the information. So this is holding company. This is the subsidiary company, or let's call this as parent. This is the parent company. This is the column for the adjustments. And this is the total. Let's begin first of all with the asset side of the balance sheet. Now, you know your focus very clear. As you proceed with the consolidated balance sheet, intercompany owings at the back of the mind, fair value adjustments at the back of the mind, and there is also stock reserve at the back of the mind. 3 calculations at least. Stock reserve eliminations, intercompany owings eliminations, and there is the aspect of fair value adjustments. Let's begin. So we start with the asset side of the balance sheet. So we've got, first of all, land and building. So land and building is appearing at 468. And the subsidiary is 561,600. And then there was a fair value change. The land and building was 3,12,000, but there was no additional depreciation. So we just keep that in the adjustments. This will be a good way of keeping a track of all the adjustments. So this is 13,41,600. The next is plant and machinery. That's 748,800. That's 421,200. Then there was a fair value adjustments. I'll have to go back to the analysis. So this was 179,400. 179,400. and there was a depreciation 7,800. So this works out at a total of this is 748, 800, 421, 200, 179, 400, and 7,800. So plus this is 748, 800, 421, 200, 179, 400, 7,800. This is again same figure by chance, of course. Then next we are given investments that would not appear in the balance sheet. Let's take the goodwill. Goodwill we have computed already. Okay, I was yet to get the goodwill. So this is 1248, 496, 542, 16,55140. This is 89,402. This is 89,402. That is the goodwill computed. Okay, let's go further. We are given inventories. There is a fair value adjustments for inventories. Inventories is 374,400. And this is supposed to be 113,600. Fair value changes of the inventory is 46,800. No stock reserve. That comes to 534,800. Next, we are given the trade receivables, and that is 186,500. That's 186,500 and 124,800. And trade receivable, I think there is no intercompany owings. There's no fair value adjustments. So we can directly take the total. This is 311,300. Then there is cash and cash equivalents, and that is 45,200, and that's 24,900. So 45 and 24, that's 70,100. And I think that's it on the asset side of the balance sheet. Let's take the sum total of the asset side. Then we'll go to the liability side as well. So 1341,600, 89,402. I think this is coming to 3688, 3688,802. So 36,88,802, that is the total on the asset side. Then we focus on equity and liability side as well. So let's extend the balance sheet, same formatting. Parent, subsidiary, adjustments, and the total. So parent company, subsidiary company, adjustments, and the total. Let's take the equity and liability side. So I think first we'll take the equity share capital, which is of course of the parent company only, 15,60,000. Then we can consider the other equity. So other equity, we have got two elements. One is other reserves and one is retained earnings. And I think we can take the NCI as well. So that's on step 6. So this is 936,203,502. 203,502. 936 is other reserves. And then we've got the NCI. The NCI is to the extent of 507,300. 507,300 is NCI. So this is picked up from the step number 6, and that is picked up from the NCI. Okay, so then we are given the further information, that is trades payable. Trades payable is 146,900, and this is 34,300. And there was a fair value adjustments for the trades payable, that's 31,200. So 146,900, 34,300, 31,200, that's 2,12,400. And we're given the short-term borrowings. The short-term borrowings is to the extent of 249,600, and that's 20,000. No fair value adjustments, it comes to 269,600. And I think this should close the balance sheet for the company. Let's see the total. So 1560, 936. That's right, it comes to 3688,802. That is absolutely correct. So that makes us a consolidated balance sheet. So that was a good one, not a very tough question indeed, but a good one indeed. So I think that gave us an exposure in terms of running all the adjustments, dividends. Then there is fair value adjustments. Typically, there was no stock reserve or goodwill impairment. No worry, you're going to see that in the next questions maybe. Okay, so this is one broader question. Let's now go further to the next one with you. So we'll do another examination question with you. And this is a question which came in January 2021. I think this is by far one of the good questions which has come in the exams, because there was a point which relates to the concept of omission as well, where I feel making an extract balance sheet becomes pertinent in nature. Okay, let's, I think, read the inputs. So question number 12, I am given, it says on 1st April 17, A acquired 80% share capital of S. On acquisition date, the share capital and reserves are given respectively, and A paid an initial cash consideration. Additionally, A issued 2 lakh equity shares with a nominal value of 1 at a current value of 1.8. Your purchase consideration is comprising of initial cash, and there is an issue of shares as well. It is also agreed that A would pay a further sum of 5 lakhs after 3 years. That becomes a deferred consideration. Then the cost of capital is 10% and the appropriate discount rate is given. Now, we need to be careful that if it is a case of a DC, then there is an unwinding of discount also to be applied. So then he says the shares and the deferred considerations have not yet been recorded by A. Now you would recall the information which I gave you in terms of Ind AS 103. When I gave you that if there is any kind of omissions with reference to DC or CC, the impact on the step number 7, pre-acquisition, pre-business combination, and then post-business combination. So I think that knowledge will become handy out here. So it says the shares and DC have not been recorded by A, and then the balance sheet on March 19 is given. That's 2 years post the acquisition date. Then he says in the additional information, on the date of acquisition, the fair value of the plant exceeded the book value by 2 lakhs, and the plant has got a remaining life, it says 5 years. Consolidated goodwill impaired by so and so. It says A Limited Group values the NCI using a fair value, and the fair value of the 20% NCI already stated. You're going to make a consolidated balance sheet on March 2019, and this is a January 2021 15 marks question. I think let's begin. So I think mainly the adjustment is goodwill impairment is there, the fair value adjustments are there, and then there is an omission in terms of the PC. Let's begin. Question number 12. So I think in this particular case, Since it is a case of omission of shares and a DC, before you begin the 7-step model, it's important to first of all make an extract balance sheet. So we're going to first see the entries which were omitted on the date of acquisition and its consequential impacts post the acquisition date, and then make the extract. So we'll first work on the omissions. Let's first work on the omissions by the parent company. So what I'll do, I think let's make an interesting chart. So that would be better because this will give us a complete view. So this is date of acquisition. The date of acquisition is 1st April 17. And because of the omission, let's also see the impact on March 18 as well as March 19. It's a good way, to present the answer, because we can very clearly tell the examiner the entries which were omitted on acquisition date and its impact consequentially post the business combination. Okay, so let's look at the journal entries. Let's look at the journal entries. So we are clearly given in the question that there has been an omission in terms of shares as well as DC. It says A issued 2 lakh shares with a face value 1 at the rate of 1.8. So what am I supposed to do? That there is shares issued. So can I say if I would have taken this entry, the entry would have been investment gets a debit, equity share capital gets a credit, and share premium gets a credit. If this entry was not omitted, you would have taken the debit to the investment, face value in the shares, and the rest is premium. So this is 2 lakh shares of 1 each. And the issue price is 1.8. So this is 3.6 lakh, 2 lakhs into 1.8. And the difference becomes the premium. Because of this entry, no impacts in the next 2 years. And then the next we are given the deferred consideration. So as far as deferred consideration is concerned, the company agreed to pay 5 lakhs after 3 years. So the entry which would have been done, investment would have got a debit and DC would have got a credit. So we will discount this 5 lakhs at 10%. That's 3 lakhs 75. That's 3 lakhs 75. And because of this omission, there are definitely consequential changes. Had you taken the DC, you would have continued with the unwinding for the next 2 years as well. So it's time to take the unwinding on this. So the entry for the unwinding is finance charge gets a debit and DC gets a credit. So 10% interest would mean 37,500. And then in the next year, on the cumulative DC, we take a 10% interest, that's 41,250. Okay, so I think this takes care of the journal entries which we omitted. Had the shares been issued, this would have been the entry. Had the DC been incorporated, this would have been the entry. Omission of DC would have led to unwinding of discount which you've taken. Omission in terms of shares, there would have been no impact altogether. Okay. So now I think with this, there is a need to make an extract balance sheet, because you should also give to the examiner that if these omissions hadn't occurred, what would have been the relevant figures in the balance sheet. So when you go to do the consolidation, we will consider that all this information gets incorporated. So let's make the extract balance sheet now. So this is the balance sheet of the parent company because he has done the omission. So we're looking at the balance sheet of the parent company is just an extract. So this is the amount and I'll take this as particulars. Now we'll consider the information in terms of the assets and liabilities, what all have to be incorporated. So let's have a look. We'll revisit the entries and see what are the changes are required in the balance sheet. So I think if we just make a quick look at the entries, I think on the asset side, the investment is the only figure which is changing. So on the asset side, we're just making the changes in the investment figure. So if you look at the investment in the balance sheet, it's appearing at 1,000. This is all in terms of 1,000. The balance sheet is all in terms of 1,000. So once you take the investment, you've omitted 360 and 375. So 3,60,000 in terms of thousands would be 360, and 375 in terms of thousands would be 375. So that works out at 1735. So that changes on the asset side. Then I guess on the liability side, we've got share capital, premium, DC, etc. So on the equity and liabilities, we need to make changes on the equity share capital in terms of other equity, premium, as well as retained earnings. The share capital in the balance sheet is to the extent of 2,000, and we've issued equity share capital, which is 200. So I think that makes it 2,200. Then share premium, I think there is no premium. It's appearing at 180. The premium is appearing at 160. There was no existing premium in the balance sheet. And as far as RE is concerned, it's 1,400. And we've taken a hit on the finance charge, that is in terms of thousands, 37.5, 41.25. 37.5, 41.25. So the finance charge is getting adjusted in terms of I. So less the finance charge for 1 year and 2 years, that's 1321.25. So I've incorporated the investments, I've incorporated the increase of the share capital premium and taken the hit on the finance charge. Let's see if there is anything else which is pending. We'll just double check. Investment done, share capital premium done, investment is done, but DC is pending, finance charge is done. So DC is the only pending issue. So we can take on the liability side. So we got a deferred consideration. Now also remember that this deferred consideration will become a current liability in nature, because this amount was payable 3 years later, 2 years have already elapsed. So you can say another 1 year it is payable. So it's a current liability in the balance sheet. So let me also make a mention that this is a current liability. So my DC was, that was 375 plus unwinding of 37.5 and 41.25. So 375, 37.5, 41.25. This is 453.75. Well, so I think a good time spent in terms of creating an extract balance sheet because of the omissions. Now you can say it becomes a question to do for the consolidation balance sheet. Because once you've taken care of the omissions in the form of extract balance sheet, that if these omissions would not have occurred, this is how the balance sheet would have looked like. Now you proceed with the 7-step model. Okay, so let's, I think, begin the inputs in terms of step number 1. So we need to get the date of acquisition and we need to get the percentage. So as far as the date of acquisition is concerned, it is 1st April 17, and the percentage is very clearly given at the question. At the very start, it is 80%. Now the category of question is, it's a acquisition at a later date. So we need 2 sub-steps in step number 2. We'll just make the regular chart for the analysis of other equity. So this is analysis of other equity. taking a pre-acquisition and taking a post-acquisition. And let's take a column for particulars. And since the examiner has already tested us in terms of, a couple of omissions, then therefore you see the level of adjustments, drastically goes down. So we are only given adjustments regarding, one is the goodwill impairment, which will impact later. So fair value adjustments are there, no stock reserves are there, and there is nothing in terms of, yes, fair value adjustments is there. So out of the three focus points, that is stock reserve not there, fair value adjustments are there, and we just take care of the analysis. So let's begin with the balance sheet of the subsidiary. So subsidiary has got a retained earnings to the extent of 300 in the balance sheet. So let's take care of the RE. We again make a timeline. On a very safe side, always better to make a timeline. So we are given the RE on the date of acquisition was 125. So first April 17 and this is March 19. So this is pre-date of acquisition April 17 and this is April 17 till the balance sheet date, that is March 19 post. So now we know that the post-acquisition period is comprising a total of 2 years in this case. Now, once it is a period of 2 years, you need to be careful that the depreciation which you will consider is going to be for 2 years now, because your post-acquisition has got 2 years in this case. Okay, so coming back to the inputs, RE on the balance sheet is 300 and on the date of acquisition is 125. So we can easily get the data that this is pre and the increase is post. So 125 is pre and 175 is post. That's it. Nothing else is there in the balance sheet as far as the other equity is concerned. Now the only information required is the fair value adjustments. So on the fair value adjustments, I think we're given the information for a plant. So we're given in the point number 1 in the addition information, fair value of the plant exceeded the book value by 2 lakhs, which means 200. That is the fair value adjustments. And it has got a life of 5 years. So we need to consider the additional depreciation as well. So this 200 will be divided by 5 years. It comes to 40 is the depreciation per annum. The remaining life of the asset is supposed to be 5 years, so we get an annual depreciation 40. In the post-acquisition period, there are 2 years, so 40 into 2, that makes it 80. I guess that's it. Nothing else is given. We've taken care of the fair value adjustments. We've taken care of the analysis. No stock reserve, nothing. As simple as that. So let's get the pre and the post-acquisition figures. That's 325 and that's, I guess, 95. Right, so I think this information is done. So we have got now the step number 2A. We can proceed to the step number 2B. So step number 2B, and that is getting the net assets on the date of acquisition, which is nothing but a sum total of the equity share capital and the other equity which is pre-acquisition in nature. So for this purpose, we take the share capital of the subsidiary. The share capital of the subsidiary is given 500 and the pre-acquisition equity you just taken in step number 2A, and that is 825. I guess step number 2B is done. Now let's go to the step number 3. Systematically, step by step, and it's not a difficult deal. Now we get the purchase consideration. Now when you get the purchase consideration, your focus is you made an extract balance sheet. And now when you go to pick up the investments, you're not going to see the balance sheet but you will look at the extract balance sheet which you've prepared. So let's go back to the extract balance sheet and see the information. Investment is appearing at 1735. That is the investment in the subsidiary company. That comes to 1735. Well, that is step number 3. Now let's go to the step number 4. The step number 4 is on the calculation of the NCI. And for NCI, I'm clearly given we need the NCI at fair value on the date of acquisition, and to this we add the share in post-acquisition profits. And I think least we forget, there is a goodwill impairment which is stated, and since the NCI is at a fair value, the goodwill is supposed to be full, so the NCI would also bear the share in terms of impairment. So NCI, I'm given in the point number 3, it says the fair value of the NCI is 380. And I guess if I take the post-acquisition, let's go back to the analysis. So post-acquisition profit is 95. So out of this 95, 20% belongs to the NCI. And we take care of the goodwill impairment, the share of the NCI in the goodwill impairment. So goodwill stands impaired to the extent of 258. 20% is the share of NCI, that's 51.6. So we can get the NCI on the balance sheet date as well. So that's 380, 19, and 51.6. This is 347.4. Okay, the step number 4 stands done. Now we go to the step number 5, which is goodwill. Then we go to the step number 5, that is goodwill or the bargain purchase gain, call it as a capital reserve, which is nothing but we're just going to pick up the information from the previous steps itself. So we take care of the purchase consideration, add the NCI, reduce the net assets on date of acquisition. And I guess before we forget, we also need to consider the goodwill impairment. So it is always good to first create a formatting as well, because then you're ready with the track that what information is to be taken, you would know that. Because once you're clear that, okay, this is all the information required, you can just keep, fitting all that information there and there. So as far as PC is concerned, it is 1735. As far as NCI on acquisition date is concerned, it is 380. And as far as net assets is concerned, it is 825. So we get the goodwill. So 1735, 380. This is 1290. Impairment, of course, is going to be the complete figure, because when you consider the goodwill figure, all the figure of impairment, and that is to the extent of 258. So this comes to 1032 is the figure of goodwill. Right, I guess the step number 5 gets done, and now we are ready with the step number 6, that is other equity. So we go to the step number 6, which is consolidated balance sheet, other equity. So here again, you get your focus points: consolidated balance sheet, other equity, the share in the post-acquisition, then we need the goodwill impairment and the stock reserve, which is downstream. There is no stock reserve, there is no dividends. So we just need to take care of the post-acquisition and the goodwill impairment. So now there are a couple of columns which we need to consider in this case, because they've got RE and they've got a retained earnings both. So I think we'll take two columns in this case. So we've got the column for RE as well as for the premium. RE, it is good to pick up the information from the extract balance sheet. Because as far as RE is concerned, you've already made some adjustments. So we are going to pick this not from the balance sheet of the parent, but from the extract balance sheet. So let's pick up the information extract balance sheet. Premium is 160. This is 1321.25. 1321.25, and this is 160. This is the parent company's own RE and own premium. Further, let's consider the share in post-acquisition. We consider the share in the post-acquisition profits, and that's from the analysis 95 into 80%. So this is 95 into 80%, 76. And then we need goodwill impairment. And goodwill impairment will also be 80% parent share. So goodwill impairment was 258 into 80%. That's 206.4. Okay, so I think based on this information, we are got the other equity figure for the extract balance for the balance sheet consolidation. So let's see the information. This is 160, 1321.25, and this is, I guess, 1190.85. So this is 1190.85, and we get the premium as well. Okay, so far so good. Now we are finally ready to go to the step number 7, making a consolidated balance sheet as well. So let's make the consolidated balance sheet. Step number 7, that is consolidated balance sheet. The technique remains the same. So we take a column for the parent, a column for the subsidiary, a column for the adjustments, and a column for the total. So this is parent company, subsidiary company, adjustments, as well as the total. Okay, so now let's begin with the asset side of the balance sheet. We'll pick information one by one. So we've got on the asset side, there is a PPE. So I think in the PPE, we've got 5,500 and 1,500. There was a fair value change. That was, I guess, 200. The depreciation was 80. 7,200 minus 80. 7,120. That's PPE. Investments will, of course, not appear in the balance sheet, but least we forget, we consider goodwill. Goodwill was to the tune of 1,032. Then there is inventory, receivables, as well as cash. Inventory is 550 and 100. And I think inventory, there are no changes. Receivable is 400 and 200. No intercompany owings. Cash is 250. So it makes life simple. So this is 650. That is 600. And that is 250. I think that's it on the asset side of the balance sheet. So we can get the sum total of the asset side. 7,120, 1,032, 650. This comes to 9,652. Right, so that is on the asset side of the balance sheet. Now let's focus on the liability side of the balance sheet. Same formatting. So liability side, one column for the parent, subsidiary, adjustments, and the total. So this is the equity and the liability side. So we pick up the equity share capital, then the other equity comprising of premium, retained earnings, and let's take the NCI. So that's the basic information to be picked up every time. So share capital extract balance sheet, that's 2200. Then share premium from the step number 6, 160, this is 1190.85. That is RE picked up from the step number 6, and we've got NCI. So as far as NCI is concerned, 347.4. So we can easily pick up this information. This comes from the step 6, and this works out from the NCI calculations. Okay, then further we are given non-current liabilities, and that is 3,400. No adjustments, that's 3,400. Current liabilities, least we forget, we have got a DC as well. Let's take the DC separately. So current liability is 1250 and it is 650. That is, I guess, 1900. And DC will be taken from the extract balance sheet. So let's go back to the extract balance sheet to pick up the DC. That is 453.75. 453.75, and I think that's the total of the balance sheet. So let's take the total. $9,652. That is the total of the balance sheet. Wow. So the balance sheet is tallied, the assets and liabilities is done. That took us quite a good number of time, but I think the questions are easy. If you just look at the mind maps we prepared for each and every step, and if you just concentrate on that mind map as you fill up the information, trust me, it is not at all a difficult job. Okay, now we need to do one special little question further on a consolidation, because I think doing the consolidated balance sheet doesn't get over unless we add the element of a chain holding question as well. So I think we'll first take a break and then we'll do a question on a chain holding with you, which has got a little different special issues in certain steps. So let's take a break and then we'll start with the chain holding question with you after the break. Thank you. I hope you had a relaxation of mind. So I think let's come back on the agenda. So we have been doing consolidated balance sheets since morning, and we have done the consolidation process, but that was without any chain holding, where there is simply a case of a subsidiary. Now we want to look at a consolidation process when there is a chain holding. In the examination, I think there have been around 2 or 3 questions till date which have been tested on a chain holding. The process, of course, remains almost similar, but except that a few changes occurs when you do a consolidation on a chain holding. So let's, I think, make a revision in terms of how the consolidation would be done on a chain holding. So let me share a question to you on the concept of a chain holding. Let's have a look at question number 13. This is an examination question. It came in the exams in November 18. A similar question came in the exams as well. That was in July 21. It came for 16 marks in the exam. So I'm doing right now the question number 13, which is an examination question. That was the first time when the question of chain holding was tested in the exams. So let's read the inputs in this case. It says prepare the consolidated balance sheet on March 18 for a group of companies comprising Usha, Nisha, and Sandhya. And we are given the balance sheets of the company. And then it adds on the following additional information is available. It says Usha has got 80% shares in Nisha, and Nisha has got a total of 75% shares in Sandhya. And it says the holdings are all acquired on 30th September 17. The business activities of all the companies are not seasonal in nature, and therefore it can be assumed that the profits are evenly earned throughout the year. I think that goes without saying. Even if the question is silent, you can always presume, unless mentioned otherwise, the profits are earned uniformly throughout the year. Then he says on 1st April 17, the following balances stood in the books of Nisha as well as Sandhya. Then he says 5 lakh included in the inventory figure of Nisha is inventory which has been purchased from Sandhya at cost plus 25%. The parent company adopted an accounting policy to measure the NCI at a fair value, which is a quoted market price applying Ind AS 103. Assume the market price of Nisha and Sandhya are same as the respective face value. Then I guess the point number 6 you can leave, because I think that was not really relevant to the question, because even the balance sheet, somehow was given based on a division 1, but that's fine. Now it says the analysis of profits and notes to accounts will form part of your answer. Now, if you typically see that there is an adjustment with regard to stock reserve, where you can see the inventory of Nisha includes the goods which are sold by Sandhya, it is an upstream transaction in nature. Then I guess apart from that, we are not given any further adjustments, just one simple adjustment. When the question came for the first time, there was just one simple adjustment on this part. So I think let's begin with the inputs. Question number 13, chain holding. Okay, so the steps, of course, remains the same with a few changes in certain steps. I think that focus will keep as we proceed with the solution. So first of all, step number 1, we need to get the date of acquisition and the percentage. And there is something special which needs to be tackled at this particular stage. So first, let's look at the percentages. Point number 1 tells you Usha has got shares in Nisha, Nisha has got shares in Sandhya. So Usha has got shares in Nisha, and Nisha has got shares in Sandhya. So first we'll apparently note down the percentages which each has in each company, and then we'll see the special agenda. So we're given that Usha has got 80% shares in Nisha, and Nisha has got 75% shares in Sandhya, and the acquisitions were all on 30th September 17. So the date of acquisition in both the cases is 30th September 17. Now, the special agenda, what you need to take care at this stage, which is peculiar to the shareholding, you would recall, I need the effective percentage of the top company in the bottom company. So we need to calculate what is the effective percentage, of Usha in Sandhya. So we can say this is 80% of 75%. So when you take 80% of 75%, this works out at 60%. Because the consolidation is all from the Usha's perspective. So you need to see that what is the percentage Usha got in Nisha and Usha got in Sandhya, which also indirectly implies that 40% of the stake is belonging to the NCI. Right. So that is the only special addition which comes in terms of step number 1. Now, since there is a chain holding, Usha is effectively got two subsidiaries because the middle company, that is Nisha, and the bottom company, that is Sandhya, they are effectively both subsidiaries of Usha. So which means two analysis, two net assets, two goodwill, two NCI, everything becomes duplicate. It's as good as multiple subsidiaries with us. So let's go to the step number 2A. So we'll have to draw two analysis now. So we look at the step number 2A, analysis of other equity of both the middle company as well as the bottom company. So let's do them simultaneously. We'll take care of the analysis of the middle and the bottom companies both. So column for particulars, pre and post acquisition in nature. So this is for the company Nisha, and this is for the company Sandhya. This is pre-acquisition, and this is post-acquisition, and this is again pre-acquisition, and this is post-acquisition. That is particulars, and that is particulars. Okay, now we just define the dates also in advance. So the date of acquisition is, this is pre 30th September 17. And I guess my balance sheet is March 18. So this is going to be acquisition date 30th September 17 till March 18. And even this is same. This is pre 30th September 17. And this is from the date of acquisition 30th September 17 till 31st March 18. So this is 31st March 18. It's always a good exercise to define the pre and the post. And when you define the post, your focus should immediately turn to the point that yes, out of the current year, 6 months is post acquisition and 6 months is pre. Only 6 months of the current year is in the post. So the current year time ratio effectively is 1:1. Okay, now the same focus points which are there in the back of the mind, that you need to consider the analysis, other equity of the subsidiary, fair value adjustments, not given in the question, stock reserve, it is upstream, so we need to be careful out here. So let's begin the analysis in terms of Nisha. So Nisha has got a reserve, and let's make a timeline. So if you look at the balance sheet of Nisha, reserves on the balance sheet date is 50. And at the beginning of the year, it's given in point number 3, on 1st April, the balances at the beginning of the year, Nisha has got a reserve of 40. So my acquisition date is middle of the year. So we can say that 40 becomes pre, and the increase will be divided in the time ratio. And I think now we also need to do another interesting input. In the post-acquisition column, you should segregate that this is reserve and this is RE. In the pre-acquisition, you need not make a separate column for reserves and RE. But when it comes to the post-acquisition, to ensure a line-by-line addition, you should segregate the sub-columns as well. So we'll take a column for reserves and we'll take a column for RE. Now let's go to the next item, that is retained earnings. We again consider a timeline. And in terms of the timeline for RE, Nisha has got a retained earnings 25 at the end and it's 10 at the beginning. So we can say that 10 is pre and the increase of 15 goes in the time ratio 7.5. So you can see reserves taken to reserves, RE taken to RE. I think that's it. So there's nothing else. For the stock reserve, it was a transaction where Sandhya made a sale to Usha. So that would be taken care in the Sandhya's analysis. So we're not given anything else. So this analysis gets done. So except that, the competitions increases because it's practically two subsidiaries and this comes out to 62.5. Right, so this is Nisha. Now let's go to Sandhya. Similar calculations. We take the reserves, take a timeline, and let's see the reserves at the beginning and at the end. The reserves for Sandhya is standing at the end at 40, and at the beginning it was 30. So we can say 30 becomes pre and 10 becomes post. Let's take a separate column for reserves and retained earnings. Similarly, we do the calculations for the RE as well. Let's take a timeline. So let's see the balance at the end and the beginning. So RE is supposed to be 30 at the end and it is 15 at the beginning. So 15 becomes pre and the increase in time ratio 7.5 and this is 7.5. So we have taken care of the other equity in the respective balance sheets of both the company. Now the only thing to be seen is the stock reserve, which is upstream in nature. We go to the point number 4. It says 5 lakh is included in the inventory of Nisha, which is purchased from Sandhya at cost plus 25%. So when you say cost plus 25%, your maths would tell you 1/4 on cost and it is 1/5 on sale. So on 5 lakhs of unsold inventory, 1/5 would mean a profit margin 1 lakh. So there is a need to eliminate the stock reserve, which is on 5 lakh 1 by 5. So we eliminate this from the retained earnings in the post acquisition. I think that's it. So this takes care of the analysis for bottom company as well. So this is 10, this is 6.5, and this is 52.5. Right, so my step number 2A is done. We've got the analysis of both the companies. Now let's go to the step number 2B, that is net assets. So we go to the step number 2B, which is calculating the net assets on the date of acquisition at a fair value. So you again need to do two calculations separately. So we'll do two separate calculations for the two companies. One is for Nisha and one is for Sandhya. So we need the sum total of the equity share capital and the other equity, which is pre-acquisition in nature. That's it. We're just organizing inputs and we get the net assets about the company. So let's consider the sum total of the share capital as well as the pre-acquisition equity. So for the equity share capital, you need to go back to the balance sheet. So equity share capital of Nisha is 200 and Sandhya is 160. And pre-acquisition is available in the analysis. So the pre-acquisition is 62.5, 52.5. This is 62.5. This is 52.5. So this is 262.5 and this is 212.5. That's right. Okay, so I think the step number 2A and 2B is done. Now comes the crucial step. PC is not a big deal, but I think the chain holding, you need to be careful on the calculations of NCI and goodwill. That's where we need to apply careful mind. So let's do one thing. Let's make the step number 3 here only. That is the calculation of the PC. So we've got the investment in Nisha and the investment in Sandhya. I'll just pick up the values in the balance sheet for the investments. So we are given the investments in the balance sheet. So in Nisha, it is 170 and in Sandhya, it is 140. But. So the crucial point out here is we are doing the consolidation all from Usha's perspective. So this is the cost of acquisition which the middle company, that is Nisha, paid to Sandhya. But we need to see what is the cost which is from the top company Usha's perspective. So Usha has got 80% shares in Nisha, so he funded 80% of the cost of acquisition. Since he funded 80% cost of acquisition, so we will effectively take this as 80%. That's another change which you need to consider in investment. So when you take the PC, you need to remember that the shares which middle is got in the bottom, that has to be converted from the top company's point of view. So 140 into 80%, that's 112. Okay, now we are ready to go to the step number 4 and step 5. So I'll just organize my step number 4 and 5 together, because there is going to be some common calculations out here. Step 4 is NCI and step number 5 is supposed to be goodwill or the capital reserve. So I think it's a good idea in terms of a chain holding question that you organize your goodwill NCI together, because there is some common calculations to be seen in terms of chain holding. So let's first organize the information. We'll first just organize the information. So we need the NCI for the two companies. So we'll organize this separately. And we also need the goodwill for the two companies. So we'll first just put the information and then I think we'll fill up the data. That would be the easier way to do it. So we've got Nisha, we've got Sandhya. So we've got Nisha and we've got Sandhya. So let's first organize the information, then we'll fill up the data. Now, as far as NCI is concerned, in this particular case, we need NCI on date of acquisition. And I think it is very clearly stated in the question in the point number, it says in the point number 5, the parents adopted the accounting policy to measure the NCI at a fair value. So we need the NCI on the date of acquisition at fair value. This will add the share in post acquisition. We'll add the share in the post acquisition and something else, we'll take care. And in terms of goodwill, we need PC, we need the NCI on date of acquisition, and then we need to compare this with the net assets on date of acquisition. Now, I think before we begin, something which you should always keep in mind when you're doing these calculations, you should watch out the percentages to be kept in mind. So I think if I draw my focus in terms of the percentage, here the parent has got, it was 80%, I think. Yes, here the parent has got a 80% stake. So since the parent has got an 80% stake, the NCI has got 20%, but here we need to consider 40%, what we computed in step 1. So when you're calculating your NCI, it's good to organize, because for the middle company, we know 80% parent, 20% NCI. But for the bottom company, we took the effective percentage in step 1, 60-40. Here again, we can say this is based on 80%. And this is based on a 60%, what you computed in step number 1. Now let's proceed with the data. We're now going to pick up the informations one by one on this area. So first of all, let's take the purchase consideration. The purchase consideration is 170 and 112. The purchase consideration is 170 and this is 112, which you've already converted based on effective percentage. The NCI on the date of acquisition is going to be picked up from here. So let's consider the NCI calculations in this case. Now for the NCI, I am clearly given, it says assume the market price of Nisha and Sandhya is equal to the face value. So which means the fair value and the face values are common. So if I consider the share capital as good as the market price, the share capital of Nisha is 200 into 20%. That's 40. The face value is being taken as the market price. Sandhya is 160 and that comes to 40%. That is 64. So this is the share capital at a market price, which is equal to the fair value. So fit this out here, 40 and 64. Now let's consider the share in the post acquisitions. The share in the post acquisitions, this is 5 and 7.5, 12.5, and this is 16.5. So this is 12.5 into 20%, and this is 16.5 into 40%. I've taken the reserves and the REs put together because we need to consider the reserves also. We need to consider the other figure also. Okay, I think there is a little calculation error, I guess, done. Oh, missed out the 10 doesn't get into here. A little error. This was 5 and 5, slight error to be rectified. So this is going to be 5 because that was in the time ratio. So let me just rectify that. That's 57.5. Okay, so this is rectified. Then let's go ahead. So this will also slightly change to 57.5. So this is going to be 57.5 to 17.5. And I think let's see the impact of this further. Yes, I think now this is going to be changing because I made the change. That is 5 and 6.5, 11.5. So this is 11.5 into 40%. Yes. Okay, so this is 12.5 into 20%. That's 2.5. 11.5 into 40%. That's 4.6. So on the apparent level, NCI done so far. and this is done. Now let's take the net assets. That's 262.5 and that's 217.5. So at least we can get the goodwill or the bargain purchase gain. This is coming to 52.5 capital reserve. And this is coming to 41.5 capital reserve again. In both the cases, the PC NCI is greater as compared to net assets. We can just add the two as well. So the total capital reserve comes to 94. Now, the only caution which you need to be careful on is when you took the PC and goodwill, you took 80% of this because the top company financed 80%. So you need to appreciate that 80% of the amount is financed by the parent. So 20% is financed by the NCI. So since you've taken 80% out there, the only caution which you need to remember in this case, let's put it like this, that we need to consider the remaining 20% out here because 80% is financed by the parent company and 20% is financed by the NCI of Nisha. So which means in this particular case, if I don't consider the 20%, it would continue to appear in the balance sheet on the asset side. So it's important that we set it off. We are in detailed discussions on this, the reason of this treatment in the regular sessions as well, that since this amount is funded with the NCI, we need to eliminate this from the NCI. So we take 20%. So what was 20%? 140 into 20% would mean 28. So that is one input which we need to consider. So now let's get the information. This is a total of 68.6 for Sandhya. And this is minus 28. That comes to 14.5. So we can take the sum total of this as well for the balance sheet perspective. So 68.6 plus this, that comes to 83.1. Right, so I think that takes care of the step number 4 and the step number 5, which is on the goodwill and NCI and the special issue considering 80% investment in PC, 20% reduction in NCI, 80% financed by the parent, 20% financed by the NCI. Okay, now let's go on to the step number 6. So now let's go to the step number 6. And that is making the consolidated balance sheet, that is other equity. Consolidated balance sheet, other equity, which is nothing but, it is making a statement of changes in equity. It's like a consolidated SOKI, what you're preparing. Now, one focus point, which again, I would like to draw, that when you're making the step number 6, it's a good exercise to organize the data. Because once you organize the data, your mind will be very clear in terms of what is to be taken. So in this particular case, you've got 3 focus points with you. The first focus point is considering the parent company's own as a base, share in post-acquisition, goodwill impairment, stock reserves, which are downstream in nature. In this case, stock reserves were upstream. There was no goodwill impairment, so just the post-acquisitions, that's it. And I would also suggest that in this particular case, we've got a capital reserve. Let's insert that out here. So let's make a little more comprehensive statement of changes in equity. So we've got a column for 3 sub-columns for the reserve and surplus. We've got reserves, we've got RE. So we've got reserves, we've got RE. And I think let's take the capital reserve as well. Because this capital reserve which you've computed is going to be a part of the other equity in the console. So let's take the parent company's own reserves as a base. So reserves of Usha is 90, retained earnings 80, there is no capital reserve. We consider plus the share in post-acquisition. We consider the share in the post-acquisition very carefully. Reserves in the reserves, RE in the RE. So we've got Usha in Nisha and we've got Usha in Sandhya effectively. So let's go back to the step number 2A. So first of all, for Nisha, 5 and 7.5 and 5 and 6.5. This is 5, this is 7.5, this is 5, this is 6.5. We need the share. So this is 80%, and this is 60%, this is 80%, and this is 60%. So 80% Usha in Nisha and 60% Usha in Sandhya effectively. So this works out at 4, that's 6, that's 3.9, and that's 3. And I think we can take the capital reserve as well. So what is the capital reserve on business combination? I think we had taken the sum total that was 94. So I think that's it. So there is nothing. So everything is taken care. So we can get the other equity as a total now. So let's consider the sum total of this. So this is 94 only. 80 plus 9.9, that's 89.9. And that's, I think, 97. I think that's all which is there on the liability side, I guess. So this is 97, that's 89.9, and we got a capital reserve. Now let's, I think, make the consolidated balance sheet. Now, once you're making the consolidated balance sheet, now you've got effectively 3 companies, the parent and the 2 subsidiary. So we need 4 columns, parent, 2 subsidiaries, adjustments, and the total. So let's go to the step number 7. So we go to the step number 7, making a consolidated balance sheet. So we'll have to make now a couple of columns because there is a parent, 2 subsidiaries, adjustments, and total. So 1 is for the parent and 2 for the subsidiaries, then 1 for the adjustments and 1 for the total. So this is how, we can easily track in terms of the movements. So this is parent company, this is Usha, and these are the subsidiary companies. This is Nisha and Sandhya. And then we have got the adjustments column, and then we've got the total column. Okay, so let's begin with the asset side of the balance sheet in this case. So there are no adjustments per se, except the stock reserve, which is to be taken. Other than that, I guess there is nothing else. So from the asset side, we've got tangible assets. Let's call it as PPE. So this is 160, 180, 160, 180, and 150. No fair value adjustments. So we simply take the total, it is 490. Investments will not appear in the balance sheet. Then we've got the current assets, cash, and then there is bill receivable, trade receivable, as well as inventories, Inventories, we've got a stock reserve. Rest, we can just take it as it is. The cash is 114, 2020. That's 2020, so that's 154. Then bill receivable is 36. But there is something interesting, which is given within the balance sheet. He's given within the balance sheet because if you look at the bills payable in the balance sheet, suddenly in the bills payable it says that there is a payable to Usha Sandhya. So from the bills payable elimination, from the bill receivable elimination, so 15 and 35, 50 is the elimination. So this works out at net 1. Intercompany owings eliminated. Trade receivables is 130.50, 130.50 and 110. So 130.50 and 110, that's 290. And then there is inventories 110.35, 110.35.25, and I think there was a stock reserve that was 1. So 110.35.25 and 1, this is 169. And this will give us the total of the asset side of the balance sheet. So let's see what is the total of the balance sheet. That's 1104. Right, so I think the asset side of the balance sheet is done. Now let's focus on the liability side of the balance sheet. The formatting continues. 1 column for the parent, 2 columns for the subsidiary, adjustments, and the total. So we've got parent company, subsidiary company, adjustments, and the total. So this is the equity and the liability section. So let's begin with, first of all, the equity section, where we've got equity share capital. Then there is other equity comprising of the reserves, the retained earnings, the capital reserve, and there is NCI. This is, set items which you should take at the very start, that when you're picking up the information, just pick up all this information from the relevant places. So equity share capital for the parent, that's 300. Then we go to step 6, and that's 9789.9. 9789.9, 94. And then we take care of the NCI, that's 83.1. So this is all the information picked up from the previous steps. So then we are given no non-current liabilities, we're just given current liabilities. And in the current liabilities, we've got trades payable, and there is a bills payable. Trades payable is 235, 115, and it's 90. So this is 440. And the bills payable, we've got 15 and 35, and this is 0. But there is an elimination of intercompany owing, so that becomes nil. Right, I think that's the equity liabilities should agree. That's 1104. And that's right. The assets and the liability section gets tallied on that. Wow, wonderful indeed. So that was a balance sheet on the concept of a chain holding. So we've done questions on a balance sheet so far, which is pertaining to the consolidation, without a chain holding, a normal one, and with a chain holding. Now it's time to revisit on the conceptual part of a consolidated P&L. So I'm going to make now a mind map in terms of what are the issues to be kept when you're making a consolidated profit and loss. Because the same adjustments which you confronted in terms of a balance sheet, so intercompany owings, stock reserve up and down, as well as the fair value adjustments and the goodwill impairment, and if there is any omissions. So let's have a look in terms of what is going to be the impact of these inputs in terms of the consolidated P&L. So let's make the second mind map for the day. The first one was on the balance sheet, but this is on the income statement. So let's call this as the mind map number 2 for the day. I don't know what comes to my mind is further. So far, we are looking at a subsidiary, and then in the next session, we're also going to look at an associate as well. So I am definitely going to make a good mind map in terms of that if you get a question where there is a subsidiary and an associate put together, and you're required to make, let's say, a consolidated balance sheet, or let's say a consolidated income statement, your mind needs to be very clear that in terms of all these 5 adjustments, what is the impact in the balance sheet as well as the P&L for a subsidiary as well as an associate? If all those permutation combinations are clear, trust me, the life is sorted. Okay, so we are making a consolidated P&L mind map in terms of consolidated profit and loss. Consolidated income statement, or let's call it as a consolidated P&L. So I think in this particular case, what I will do, first of all, I'll run through that. Let's say if you're looking at a consolidated P&L, what are the impact of those 5 adjustments? So let's make this in a chart form itself. So we are taking a consolidated P&L. So let's see the focus points: the parent, the subsidiary, the adjustments, and the total. So this is for the parent company, subsidiary company, and we've got adjustments, and we've got a total. Now, I'm going to make my mind run through one by one in terms of all the adjustments. But before you start a consolidated P&L, I think one of the crucial focus points is the acquisition date. Because if your acquisition date is somewhere, before the current year, the entire current year is post-acquisition, and you will land up doing a consolidation for 12 months. But if the date of acquisition is somewhere in the current year itself, then the consolidation of the P&L will be pro rata number of months. So I think your first focus point that we should look into the date of acquisition. Possibility number 1, it is before current year. If it is before current year, then current year is post-acquisition. Then you can consolidate for 12 months. Then in this case, you can consolidate for 12 months itself. But if it is in the current year, if the date of acquisition is in the current year, then we can say current year is pre plus post. The current year is pre plus post, and we need to consolidate only post-acquisition. We need to consolidate only post-acquisition. So your first focus points would always be to land up looking at the date of acquisition. If your date of acquisition is before the current year, you take a 12 months, say 12 months income and expense. If it is in the current year, pro rata. Next. Now, let's consider the inputs with regard to the revenue, for example. So you've taken the sales. You take the sales of the parent, you take the sales of the subsidiary, and you also consider the cost of sales. You take the cost of sales of the parent and the subsidiary. Now, I'm looking at a stock reserve calculation. When you're looking at a stock reserve calculation, it doesn't make a difference whether it is up or down. In the consolidated P&L, you would recall the concept of upstream and downstream is irrelevant in nature. So irrespective, what do? You reduce the sale by parent to subsidiary or vice versa. up and down doesn't make a difference. And from the cost of sales also, you reduce the sale by the parent to the subsidiary and to the subsidiary to the parent. So a common reduction is done from both the sales and the cost of sale. But what you need to remember, you need to add the stock reserve in this case, whether it is upstream or whether it is downstream in nature. So this is one adjustments as far as stock reserve is concerned, that elimination of that common sale and purchase from the sales and the cost of sale. But remember to add a stock reserve to the cost of sale. That's one. The second input, I think, which I like to just put it across, that as far as intercompany owings is concerned, there is no impact. We don't need to take care of any intercompany owings in this case. So two things done: stock reserve impacts done, and intercompany owings is ignored, that is done. Now remains the fair value adjustments and the goodwill impairments. So all you need to do when you consider the depreciation or when you consider the appropriate expense where the goodwill is impairment is to be taken. So when you take the appropriate expense in this case, now when you take the depreciation, you should consider the additional depreciation, increase that additional depreciation as a part of the adjustment column. Similarly, in this case, when you consider the impairment, take the impairment as a part of the appropriate expense. So I think all the four adjustments are taken care of. Intercompany owings ignored, stock reserve eliminated from sales and cost of sale, added to the cost of sales is the stock reserve. Then there is additional depreciation, enhance the depreciation in the depreciation figure, and impairments of goodwill that would also be added to the appropriate head. And I think another thing which is worth making a mention, let's say if there has been an omission of a DC, then I think that finance charge will also be entered in the appropriate expense column. That is the interest charge. So I think let me also put it out here. So let's say we take a finance charge, then we will consider that finance charge the unwinding of discount. So this is the finance charge, which is the omission of DC. This is the omission of a deferred consideration. So if a deferred consideration stands omitted, due to which the unwinding, we lose the fact. So the unwinding, the interest expense will get added. Though it may not be added to the adjustment column, technically it can be added to the parents column. So I think let me do one thing. It will not get adjusted, I would say, technically at this stage. So this finance charge will be taken in the parents company column. That unwinding of discount which they've omitted will be taken out here. Right, so this is the impact of the adjustments in the P&L. But one of the most important elements, once you made your consolidated P&L, you need to consider the split between what is attributable to the parent and what is attributable to the NCI. So that's another area of caution. Then once you get the profits, in the consolidated P&L, we need to divide this, that this is attributable. This is attributable to two heads. It is attributable to the parent company. And it is attributable to the NCI. So I think this is another very crucial points, which we need to consider. So when you're splitting the profits in the consolidated P&L between the parent and the NCI, you need to calculate the share of NCI on a separate basis. So this figure needs to be computed. And this figure is taken as a balancing figure. So you can say this is computed and this becomes a balancing figure thereafter. Now, when you compute this particular figure, some crucial aspects. If you recall discussions in the regular sessions as well, that we do not consider the reported profits of the subsidiary company for the calculation of the NCI. There is a need to convert the reported earnings into, you can say, the rectified earnings. The rectified earnings in this particular case would involve, for example, the concept of additional depreciation due to fair value adjustments. The impact of goodwill impairment in the NCI is taken at a fair value, and the impact of stock reserve, which is upstream in nature. So you would pick up the reported profits of the subsidiary, make these three adjustments, get the rectified earnings, and then give the NCI the share in those rectified earnings. So let's make a note on that part. So in order to compute this figure, we need to get what is called the rectified profits. So in order to compute this figure, we need to get what is called the rectified profits in this case. So we will take the reported profits as a base. We'll take the reported profits of the subsidiary company as a base. And this, we are going to make three adjustments in this case. Adjustment number 1, 2, and 3. The first is we need to consider the additional depreciation because of the fair value adjustments. So there is a need to make a reduction of that additional depreciation because that fair value adjustments led to the additional depreciation. Second, we need to consider the goodwill impairment. And this goodwill impairment is if NCI is at fair value and therefore there is a full goodwill. Because if it is NCI at PASNA, then the impairment of goodwill is not borne by the NCI, then this calculation doesn't appear out here. And lastly, number 3, we need to consider the stock reserve, which is upstream in nature. So though in the consolidated P&L, when you're considering the adjustments, if you recall, in this particular case, it doesn't make a difference whether it is up and down. So in the consolidated P&L, the elimination of the sales and the cost, it doesn't make a difference, it is up and down. But the classification of up and down is relevant when you calculate the NCI share in the rectified profits. So typically these will be the 3 adjustments. Once you make these 3 adjustments, we are able to get the rectified profits for the calculation. So this will give me the rectified profits for the purpose of NCI calculation. So this computed figure is nothing but you can say the rectified profits into the percentage which is held by the NCI. So that was a crucial mind map in terms of the consolidated P&L, aggregating the informations in terms of adjustments. Now, your mind should stand very clear because we made revisions on the balance sheet and the P&L that on those 5 adjustments. What are the 5 adjustments? If there is intercompany owings, balance sheet P&L impact. Balance sheet is step 7, P&L is no impact. In terms of the fair value adjustments, balance sheet is step number 2, A and 7, and P&L is simply additional depreciation enhanced. The third is the stock reserve. If it is upstream, step number 2, A and 7 on the balance sheet. If it is downstream, 6 and 7, and in a P&L, it is simply adjusting, adding it to the cost of sale. The next adjustment is the goodwill impairment. So in terms of goodwill impairment, balance sheet depends whether it is fair value or it is PASNA. So it could be full goodwill is 4, 5, 6, and PASNA is supposed to be 5 and 6. And if it is supposed to be a P&L, simply you enhance the goodwill impairment in the expense. Omissions in terms of balance sheet would mean extract balance sheet, and in terms of P&L, finance charge in the P&L. So all the 5 crucial points in terms of balance sheet, in terms of P&L stands down. So what's going to be the agenda for the next session, which is our last session on the consolidation? We will be covering a question on P&L and make a walkthrough in terms of the loss of control, a bit in terms of associate and joint ventures. So a lot more to do in the next session as well. But I think that's all for the day. So I'm going to see you on Sunday for another power pack session on the consolidation revision, friends. So thank you very much for the day. Thank you. Bye bye and take care. Thank you. Same to you.